Welcome to part 2 of analyzing the balance sheet. Let's talk about the capital structure analysis before making a decision on investing on a company. Hi, I'm Linda and welcome to Life of the Big Four, where we give career, life, and study tips for a successful and prosperous business career. The most important thing here is to understand the composition of a company's capital. How much of it is debt? How much of it is equity? And is there a nice balance between the two? And how does it compare to other companies in the industry? A good formula to use is total liabilities divided by total liabilities plus total equity, also known as the debt to capital ratio, to find out how much of total capital consists of liabilities or equity. You want a good mix of the two, but too much liability may mean that the company could have problems in the future repaying their loans. Too much equity could mean a stunt in a company's growth because the value of each share has been diluted with too many investors. These are a couple extremely simple calculations you can run on the balance sheet before you make a decision on investing, but stay tuned for our income statement analysis where you'll find the most important information on financial ratios.